And markets, particularly the stock market, reflects that. In other words, if you have the economy growing at, let's say the nominal economy, nominal GDP growing at 4%, long-term corporate profits are going to grow about the same rate.
Imagine waking up one morning to headlines screaming that trillions of dollars have vanished overnight. Stock markets are plunging, retirement accounts are shrinking, and fear is spreading faster than facts. Some people panic, sell everything, and swear they'll never invest again. Others stay calm, do nothing, or even buy more. Years later, those calm investors are often the ones who quietly win. So here's the question: how do long-term thinkers manage to come out ahead, even when markets crash and chaos seems unavoidable? And more importantly, what do they understand that most people don't? Stay with me, because the answer isn't about luck, insider secrets, or superhuman nerves. It's about mindset, history, and understanding how markets actually work over time. The emotional reality of market crashes don't just hurt portfolios, they hurt confidence. When prices fall sharply, it feels personal. During the 2008 financial crisis, the S&P 500 lost about 57% of its value from peak to trough. Millions of people watched decades of savings shrink in less than 2 years. In March 2020, during the early weeks of the COVID-19 pandemic, global stock market fell more than 30% in a matter of weeks, one of the fastest declines in modern history. These moments trigger powerful emotions: fear, regret, anger. Behavioral economists have shown that humans feel losses more intensely than gains. This concept, known as loss aversion, was documented by psychologists Daniel Kahneman and Amos Tversky. It explains why many investors sell at the worst possible time. The pain of seeing losses feels unbearable. But long-term thinkers respond differently, not because they don't feel fear, but because they've trained themselves to see crashes through a wider lens. What history reveals about market crashes: one of the most important advantages long-term thinkers have is historical perspective. When you zoom out far enough, market crashes stop looking like the end of the world and start looking like recurring events. Since the late 1920s, the U.S. stock market has experienced dozens of significant declines, including the Great Depression, the oil crisis of the 1970s, the dot-com crash of the early 2000s, 2008 financial crisis, and the COVID-19 crash. Every one of these felt unprecedented at the time. Everyone came with predictions that this time is different. And yet, over the long run, the market recovered from all of them. According to data from Standard & Poor's, the S&P 500 has delivered an average annual return of roughly 10% before inflation over the long term, despite wars, recessions, political crises, and pandemics. That return includes some truly awful years, but it also includes powerful recoveries that followed. Long-term thinkers understand that volatility is not a flaw in the system. It's the price of admission. Time is the most underrated advantage in investing. Time does something extraordinary: it smooths out chaos. Short-term market movements are noisy and unpredictable. Over longer periods, the influence of economic growth, productivity, and innovation becomes dominant. Consider this: if you invested in the S&P 500 for a single day, your odds of losing money historically have been close to 46%. Over 1 year, the odds of a loss drop significantly. Over 10 years, they fall even further. Over 20 years, historically, the probability of a negative return has been extremely low. Long-term thinkers don't try to predict next month's headlines. They align their investments with long-time horizons: decades, not days. This allows compounding to work in their favor. Albert Einstein reportedly called compound interest the eighth wonder of the world. Whether or not he actually said it, the math backs up the sentiment. Compounding rewards patience and consistency. Market crashes interrupt compounding temporarily, but they don't destroy it unless investors panic and lock in losses. Wise selling during crashes often backfires. One of the most consistent findings in investment research is that investors who attempt to time the market usually underperform those who stay invested. A well-known study by Dalibor, which analyzes investor behavior, has repeatedly shown that the average investor earns significantly less than the market itself over long periods. The main reason isn't fees or poor asset selection, it's bad timing. People tend to buy after markets has already risen and sell after they've fallen. Missing just a few of the market's best days can drastically reduce long-term returns. For example, Analysis by J.P. Morgan has shown that an investor who stayed fully invested in the S&P 500 from 1999 to 2019 earned far higher returns than one who missed just the 10 best days during that period. Many of those best days occurred shortly after severe market declines, when fear was at its peak. Long-term thinkers accept a simple truth. You don't have to avoid every loss to succeed. You just have to avoid catastrophic mistakes, and panic selling is often one of them. Crashes as opportunities, not disasters. While most people see crashes as disasters, long-term thinkers often see them as opportunities. This doesn't mean they celebrate losses. It means they understand valuation. When markets fall, assets become cheaper. High-quality companies with strong balance sheets, durable business models, and long histories don't suddenly become worthless because of short-term crises. In many cases, their long-term prospects remain intact, even as their stock prices fall dramatically. Warren Buffett, one of the most successful long-term investors in history, famously said, "Be fearful when others are greedy and greedy when others are fearful." During the 2008 financial crisis, Berkshire Hathaway invested billions in companies like Goldman Sachs and General Electric at a time when confidence in the financial system was extremely low. Those investments later produced substantial gains. Long-term thinkers don't assume every crash is a buying opportunity for every asset, but they do recognize that fear often drives prices below intrinsic value, and patience allows them to benefit when reality reasserts itself. The role of diversification. Another reason long-term thinkers survive crashes is diversification. Markets don't move uniformly. While some sectors collapse, others hold up better or even grow. During the dot-com crash, technology stocks were hit especially hard, while many traditional businesses fared relatively better. During the COVID-19 pandemic, sectors like travel and hospitality suffered severe losses, while technology and healthcare performed comparatively well. Diversification doesn't prevent losses, but it reduces the risk of permanent damage. By spreading investments across different asset classes, industries, and geography, long-term thinkers avoid being overly dependent on a single outcome. This principle is backed by decades of financial research, including modern portfolio theory, which shows that diversified portfolios can improve risk-adjusted returns over time. Staying invested through uncertainty. One of the hardest things to do during a crash is nothing. The urge to act, to sell, switch strategies, or abandon investing altogether is incredibly strong. Long-term thinkers resist that urge. They understand that uncertainty is always present. Markets don't crash because the future suddenly becomes uncertain. They crash because uncertainty becomes visible. The future was always unknown. Crashes simply remind us of that fact. By building strategies that assume uncertainty rather than deny it, long-term thinkers avoid constant course correction. They rebalance periodically, contribute consistently, and stay aligned with their goals. This discipline is especially powerful for regular investors. Those who continue investing through downturns, such as through retirement plans, often benefit from buying more shares at lower prices, a concept known as dollar cost averaging. Over time, this can improve overall returns. The real battleground, ultimately, winning during market crashes, isn't about intelligence, it's about behavior. Numerous studies have shown that emotional control matters more than financial knowledge. Long-term thinkers cultivate habits that protect them from their own worst instincts. They limit how often they check their portfolios. They focus on fundamentals rather than headlines. They remind themselves why they invested in the first place. They also accept that discomfort is part of the process. Investing for the long term does not mean avoiding stress. It means tolerating it without making destructive decisions. This psychological resilience is often the difference between those who recover and those who don't. Real-world outcomes of long-term thinking. Consider investors who stayed invested after the 2008 crisis. By 2013, the U.S. stock market had fully recovered its losses. By the end of the 2010s, it had more than tripled from its crisis lows. Those who sold in fear often missed much of that recovery. The same pattern appeared after the COVID-19 crash. Markets recovered far faster than many expected. By late 2020 and into 2021, major indices reached new highs. Investors who exited during the panic and waited for certainty often re-entered at higher prices or not at all. Long-term thinkers don't get every decision right, but by staying in the game, they give themselves the chance to benefit from recovery, growth, and compounding. What long-term thinkers know that others don't. They know that markets are not a straight line upward. They know crashes are inevitable, but permanent losses are often optional. They know that patience is not passive, it's strategic. They also know that investing success is less about predicting the future and more about preparing for multiple outcomes. By aligning their strategies with time, discipline, and evidence, they turn volatility from an enemy into a temporary obstacle. Market crashes will happen again. Headlines will scream, fear will spread, and many people will make the same mistakes they always have. But now you know there's another way grounded in history, evidence, and long-term thinking. If you found this breakdown valuable and want more content that helps you think clearly about money, markets, and long-term success, make sure to like this video and subscribe to the channel. It helps more than you might realize, and it ensures you don't miss future deep dives like this one. Stay curious, stay patient, and remember, long-term thinkers don't just survive market crashes. Over time, they often come out ahead.